that I use most often. The first one is called the 382 candle or 38.2% candle, and you're going to understand why in a second. You may be looking at these going, man, Steven, that looks like a hammer or a tweezer top, and that looks a lot like a shooting star. Why are you calling it a 38.2% candle? Because the name of the candlestick pattern does not matter. Let me explain. The reason I call this a 38.2% candle is because of the rule that I have for this pattern, and what it shows us is that price or buyers, the market itself, meaning all of their participants, have pushed this market all the way down to the bottom of this wick. Remember when we talked about candlestick charts at the very beginning of the video, price moved all the way down to here. But what happened after price moved down there? Buyers came in and took control, pushing us all the way back up near the highs. This is a huge bullish sign for me and a reason to expect bullish pressure afterwards in any particular market. The reason it's called a 38.2% candle is because in order to objectively identify these candles, the only thing I do to make this extremely simple, and let me talk about the reason I do this first. If you ask people what a hammer candlestick is, or you show them a chart, I'll put a chart on the screen, and ask, is this a hammer? Or is this a hammer candlestick? You may get two different answers. What I'm trying to say is that candlestick patterns, unless you have rules for them, are subjective. And in order to have consistency in our trading, we have to be objective. So an objective rule I have for the 38.2% candle is that I pull a Fibonacci retracement from the swing low of the candle itself to the high of the candle itself. As long as the entire body of that candle is above the 38.2% retracement, then I count this as a valid 38.2% candle, and I count this as a candle that's showing me buying pressure. You guessed it, it's the exact opposite for a bearish version of this pattern, a bearish version of the 38.2% candle. What do you think I'm going to do to identify this pattern in an objective way? I'm taking a Fibonacci retracement from the top of that candle, the high, down to the low, and as long as the entire body of that candle is below the 38.2% retracement, then I know that selling pressure is likely to come into the market. Again, the way we use these types of candles is if this was to occur at the top of an uptrend, it might be a sign of a reversal. If this was to occur in a downtrend on our pullback, it might be a sign that we're about to continue in trend. We're going to talk about that on a live chart after I go through the other two candlestick patterns. So next, after the 38.2% candle, we have the engulfing candle. This is a candle you've probably heard of and you may already know how to identify, but in the Forex market, the way I identify an engulfing candle is a candle that has a larger body than the previous candle and that changes colors. So for a bullish engulfing pattern, I need to see that the previous candle was red, that the next candle is green, and that the green candle has a larger body than the previous candle. That is a bullish engulfing candle for me. We'll take a look at a bearish engulfing on a chart, so I'm not going to have to do that right here. So next up, we have the close above and close below candle. Again, all these candles are used in the same way. They're all either going to be used to help you identify reversals, market sentiment, or help you enter on trend continuation trades. Here we have close above and close below candle. Pretty self-explanatory. But a close below candle would be a candle in which the close of that candle is below the low of the previous candle. As long as that happens, that to me is showing selling pressure, and the opposite would be true in the bullish direction. We would have a close above. Again, we'll take a look at that down on the chart. But right now, let's go take a look at a few live examples of the 38.2% candle first. So here we have a good example of a 382 candle or 38.2% candle. And what I want to do is explain to you how all of these things are already coming together, and we haven't even hit the end of the video yet. What have we learned about trend? Trend is when the market is making new higher lows and higher highs. What have we learned about indicators? When the market's above the 20-period moving average, we are in a highly volatile uptrend. What have we learned about support and resistance? The previous level of resistance is likely to become support, right? Now, with all of that in mind, what did we just learn? A specific candlestick formation called the 38.2% candle. Look right here. Does this candle have a long wick? Let's talk about the psychology behind it really quickly. The candle opened here. Sellers pushed it all the way down to the bottom of the wick, but buyers took back over as soon as that happened. As soon as the sellers said, we're pushing this market down, buyers said, hell nah, we pushing it back up. And they did. We close up here closer to the highs. This happened while in an uptrend and at our area of value being this previous resistance level. Now, let's make sure this is a 38.2% candle. We have to use a Fibonacci retracement. We're pulling it from the low of the candle to the high of the candle. And once we do that, is this candle, the entire body of it, above the 38.2% retracement? It is. Therefore, objectively, we have a reason to enter this market. That's what I was talking about when I said these can be used for entries into a long-term trend. So in this case, we have a long-term uptrend. We have a market at an area of value, and we get our specific entry reason showing us buying pressure. Now, again, we're combining everything. So let's put on our position tool. What if we say, okay, one ATR, how do we play stops? With the volatility of the market that we're trading. Right now on the Aussie Canada daily chart, the ATR or average true range is 66. So let's go down to our swing low. Our swing low is right at 47 pips. That plus 66 is 113 pips. So we have a 113 pip stop loss on this specific trade. And let's say we want to use 2 times that ATR as our target. 66 times 2 is 132. So move that up to 132. And we now have our trade set up. Let's click play and see what happened. Boom, hit targets, no problem for about a 1.2 to 1 reward to risk ratio. I wanted to do that entire scenario just to show you how everything is coming together. If you like that, then make sure to go ahead and smash that. All right, so that is our 382 candlestick pattern. Let's talk about how we can use it for reversals. And just to show you that it doesn't always work, I have no idea. I've not looked at this data yet. This might work as a reversal and it may not. But right here, what do we have? We have a 382 candle at the top of an uptrend. If this market happened to be overbought on the RSI, check it out. It is. Combining other technical factors, looking left for resistance. We're not quite at a level of resistance right now, but this would be an example of the 382 candle. And why would it be an example of that candle? Because if I pull a Fibonacci retracement from the top of this candle down to the low of this candle, is the entire body below the 38.2% retracement. Yes, this is showing us selling pressure. In the same way, we would set our stop loss 1 ATR above this candle here and then have a target somewhere near these levels of support. May not work out. Or then again, if we had our targets down at this level of support, then it would have worked out. We would have hit those targets right here. So this is how we can use the 38.2% candle to help us with entries on trend continuation trades and to help us identify possible reversals. Let's take a look at a couple of live examples of the engulfing candle as well as the close above, close below candle, but essentially they all have the same use. They're all going to be used either to spot reversals or as possible entries in trend continuation trades to ride the trend up even further. Let's go ahead and look at the engulfing candle on live charts right now. While we were on the whiteboard, we looked at a bullish example of the engulfing candle. So here we're going to look at a bearish example. And again, I want you to see the things that are coming together on this trade. It is a winning trade. Yes, it's cherry picked, but it has a very good merit behind it because of the fact that, let's do this one more time. What kind of trend are we in right now? Well, according to the 20 period moving average, we're definitely in a downtrend. Price is below it. Are we making new lows and new lower highs below the 20 period moving average? Yes, we are. Here's our last low, new lower low. Here's our last high, lower high. This could be our next lower high. We are at what? The 20 period moving average. Is that an area of value or possible area of resistance? Yes, it is. All of those coming together, and then the entry pattern we can try to use in trend continuation type trades is what? This engulfing candle. As you can see here, an engulfing candle, as I explained earlier, is just a candle in the Forex market at least, whose body is larger than the previous candle, and I need a color change. Green to red, that's a color change. Is the red body larger than the green body? It is, therefore we have a valid bearish engulfing candle. here for possible entry into this trend continuation setup, pushing the market further down and showing us selling pressure. Next up, we're going to take a look at an example of the close above candle. Let's take a look at that now. Here's a good example of a close below candle. This big red candle, what happens here? We close below the low of the previous candle, and we do so. The where is very important. Like I said, you want to do it in areas of value, right? We don't want to just trade random close above and close below candles. That's not a profitable strategy. We have to combine a number of technical factors in order to create a profitable strategy. So in this case, what we have is the top of an uptrend. This market's been heading higher. What you can't see yet, we know this is a valid close below, right? You understand that, I hope, that a close below is nothing more than a candle that closes below the low of the previous candle. The opposite's true for a close above. But I want to show you how everything comes together yet again, because this happening in the middle of nowhere, like it did right here, is irrelevant. I'm not trading this just because we have a close below candle. No, I want to trade these in areas of value such as previous levels of resistance. As you can see, my gray box here is showing that this was a level of previous resistance that pushed the market around a ton. Now that we're back to this level, I have an area of value. This is another good example of how to use the RSI indicator. Here we have a overbought situation. And what do we have? We have higher highs on price, but what's the RSI doing? If you'll remember from the indicators portion of the lesson, what we were talking about in terms of divergence is higher highs on price and lower highs on the RSIs. Is that what we get here? Yes, it is. So with all of these factors coming together, it's a pretty good opportunity to try to use our close below candle as an entry on this trade. Doing so would look something like this. We have an entry at the close of that candle. The ATR is 77. So we have 98 plus 77. We're going to go 177 to make this easy math. 177 for our stop loss. We're going to put a target down at the previous level of support, which is right here. And we're going to click play to see what happens here on this specific trade. As you can see, the market pushes down. Now, here's a good reason why we use that ATR for our stop loss. If we used a 10 pip stop above our swing high, do you see how easily we would have been stopped out by this wick? Instead, we used the ATR indicator, combining all of our good technical factors to help us have a positive trade here. So with that said, that's going to do it for the candlestick patterns portion. And next